Dividend investors, bonjour! Mikey Roux here, founder of Dividend.to, passionate investor, and I'm here to help you out to invest with more conviction so you can enjoy your retirement. Today, we are talking about a topic that I love, and it is Canadian tech stocks. How could I talk about Canadian tech stocks when most of them are not paying dividend, right? And that's pretty much the purpose here. The thing is, there's a lot of Shopify and Lightspeed, and those companies are thriving like there's no tomorrow. You look at their graph and they're just like, pooh, making like thousands of percent in returns, but they're incredibly hard to analyze and to assess as an investor. Basically, you are investing in those businesses hoping they will thrive and get huge market shares like Shopify is doing, and finally publish some earnings. It's happening with Shopify right now. I have no doubt it will happen with Lightspeed, but it is very difficult to determine a value on those kind of companies because you're just trying to hope that you'll not be the last investor to invest at that huge price, and that is going to keep its momentum. For those reasons, I prefer to focus on Canadian stocks paying dividend. There are not that many, but today we're going to look at three of my favorites, three companies that I have in my portfolio, and I think that you don't necessarily have to invest in Microsoft and Apple if you're looking at tech stocks and you're Canadian to be successful. The three companies that I will cover today have one thing in common, and they offer a SaaS product. What's a SaaS? SaaS stands for Software as a Service. In simple words, you probably have Microsoft Office installed on your computer or Windows, and you're now paying a monthly fee or a yearly fee to get those software installed and being updated and upgraded every time on your computer. This is a software as a service. So you're paying like a utility bill, like either monthly or week or yearly, company for them that will provide you a software that you use, and whenever there's an update and whenever there's like new upgrades and so on, they will take care of it for you. You don't have to do anything, and you keep using the same software. What I like most about SaaS is, as a customer, you will pay the company recurring fees to use that software. Recurring revenue means a lot of clients and lots of cash flow coming in all the time. So basically it's like a subscription-based model, and this is what I love the most. And interesting enough, lots of Canadian tech stocks have been developed around SaaS, and we're going to look at three of my favorite today. Let's start with one of the biggest company that you can find in that model on the Canadian market, which is OpenText. OpenText has the benefit of trading on both markets under OTEX, so Canadian and US market. Dividend yield of 1.5%, not incredible, but still interesting. It pays its dividend in US dollars, so you have to be careful with that when you look at graph, and it has increased its dividend yearly since 2014. Relatively new dividend grower, but then again, they are growing very fast. They have focused on growing by acquisition for several years, and now they're just like having extra money so they can still buy competitors to grow their business, but at the same time reward their shareholder. What I love the most about OpenText is their diversification. They have over 100,000 clients, and they are offering so many different services. It's almost impossible for them to be more diversified like that. It's like a mutual fund of SaaS products. So what they do in simple term is they offer businesses software and applications to use their data, their information, and get the most out of it. As a business, we all have a bunch of information in our CRM, or customer relationship management software. So we know a lot of things about our customers, we know a lot of things about our providers and our product and so on. But sometimes this this information is clogged, it's hard to understand, it's hard to categorize and filter. So this is what OpenText does for their client. They offer a lot of cloud services like that, and comes with subscription obviously. And what you see on the last part of that graph is ARR by industry. You're going to see a lot of that in that presentation. ARR means annual recurring revenue. This is probably like my favorite abbreviation ever. That tells you that this money is coming in this year, but the next year and the following year after that, and as long as the customer subscribes to a service, it will continue to come in as a source of revenue. As you can see, they're not dependent on one industry or another. They are well diversified across all kinds of industries, because basically what they do is that they help businesses manage their information in a better way. If you want to go a little bit deeper and look on their website, you will find all kinds of solutions, what they do in terms of security, in terms of cloud, in terms of enterprise content management. They offer so many different services, because what they have done best in the past decades is they acquire bunch of smaller competitors in different fields. They put it together with their technology, and what they offer is they offer plenty of cross-selling opportunities to their clients. So every time that they find a software that could be interesting for companies, they just acquire it, and then they put it in their bundle, their package. They go see their client, say, hey, I have this like new features, would you like to try it? And then they just increase the subscription price and make more money out of it. Now let's take a look at their dividend triangle. What you see here is revenue going higher and higher and higher all the time. It is a little bit more complicated for the earnings, mostly because with all those acquisitions, the earnings per share will move up and down all the time. So you can see that there's something there that we need to focus on. We need to dig a little bit deeper. The dividend triangle is showing us strong revenue growth and steady in dividend increase. Keep in mind, this graph is in US dollars, because OTEX is paying their dividend in US dollar as well. So strong revenue growth, strong dividend growth, but there's a problem with earnings. So let's dig a little bit deeper there and see what's happening there and explain this before we pull the trigger and buy the stock, shall we? What we see here is the OpenText cash flow from operation, and then you can see how the company is making more money every single year. This is fueled by, I mean, I'm tempted to say thousands of acquisition, because when you look at the following graph right there, you can see that since 1991, the year that OpenText was founded, there are like so many different acquisitions there. The company is literally taking bites every single place that you can imagine in terms of the SaaS software service for businesses. And this what makes their strength. Keep in mind, they have to compete against big players like Salesforce in the US, which has like more money, stronger market capitalization, and obviously they have more money also to make acquisition. So they need to keep up that pace. This is also a risk for OpenText, because you never know if you're going to be too big, or if you're going to pay for an acquisition that will be not as profitable as you think, or you're going to get into too much debt, for example. So you always have to keep that in mind, and from year to year, sometimes they're going to disappoint the market expectations in terms of returns, because we always think that the next acquisition will be great and then they will thrive, but it's not always the case. Nevertheless, they keep a very strong balance sheet. What you see on this graph is that every time they make a huge acquisition, their leverage ratio are going up, but then as it goes down, you can kind of almost predict the next time they will make a big acquisition. Actually, it's kind of similar with the business model that TCS.TO has. A couple of months ago, I did a huge video about TCS.TO, which is a convenience store, has nothing to do with tech stocks, but they have kind of like the same operating model, and right now they're on the verge of making a big acquisition. So you might want to take a look at the link description below, take a look at this video about l'alimentation, and you're gonna thank me later. Now, back to OpenText. In conclusion, when you look at their payout ratio, you're gonna say, Mike, they can't pay their dividend. Their payout ratio is at 200%. That doesn't make any sense. All right, well, that's the thing with a company that makes a lot of acquisition. Looking at earnings will not help you that much, but if you look at the second part of that graph, the payout rate, the cash payout ratio, we are looking at a company that is using their cash flow to buy a lot of companies, and they are generating tons of free cash flow. Therefore, cash payout ratio is at 18% right now. You don't have to worry about it. You're going to keep having high single-digit dividend growth, maybe a couple of double-digit dividend growth as well. And when you look at the debt, it's relatively high at 3.6. It's growing right now because they're like always growing their debt to make new acquisition. But when you compare it with the cash flow from operation, it keeps going up for the past 5 years, generating enough cash to pay the debts and also reward shareholders with dividend increase. I'm definitely not worried about it, and I love the fact that they're well diversified. They are in growing niche because there's a huge need for companies to master their data and make sure it's secure also, and to optimize it in the future. We're going to see a lot more growth in this space for the next decade, and those are the reasons why I bought OpenText in the first place. Now, moving on to a smaller business that is not really known, called Tecsys. Tecsys, small cap, ticker is TCS.TO, small yield as well, 0.5%. Nothing to write home about, I'll give you that. Starting to increase their dividend in 2015, so small, young dividend grower there. But there's something very interesting here, and it is the company has been around for the past 35 years. And when you look at this graph, it's kind of funny because it was part of the last tech bubble. And when you look at the graph, you kind of like see the same narrative growing, and you're just like, yeah, is it the second time that we're gonna have a tech bubble and then Tecsys is gonna fly and die? This time, I don't think so. I think that they have reviewed their business model and they are very solid right now. And this is what I'm going to show you. And for that reason, I bought it in 2020. So what Tecsys does, well, obviously it's another SaaS, but this one is specialized in complex distribution system. So what they do is that they help companies with complicated supply chains to optimize them. So you can see on the graph, we're talking about warehouses management, e-commerce, client demand from both the provider and the customers. So they are able to manage all those key players in the chain, in the supply chain, to make sure that everything goes smoothly. And with the rise of e-commerce, you can imagine it is just starting right now, and it's going to continue to grow rapidly. The company has focused on complex distribution and healthcare. So 70% of their clients are complex distributors, which is kind of great because it gives a sticky business when you have a complex supply chain and you finally find a solution, a software that will help you manage it. You're not likely going to throw it in the trash every 2-3 years and start over, because it's going to cost a lot. So whenever they sign a client, they will keep it for a very long time. And then again, you guessed it, this is all subscription-based model. So you sign a client, it's there for several years, so you're going to keep getting that ARR, annual recurring revenue, on and on and on. For the healthcare, well, you can tell that there are a lot of money will be invested in the healthcare system in the upcoming years. Pandemic is a huge fuel factor here for this sector, and Tecsys will help those businesses to manage their supply chain. So there you go, you have a very strong narrative behind the stock. Now, what we look here is the dividend triangle. You can see that the share price has exploded in the past 5 years, but so are revenue and the dividend as well, which is kind of very interesting. Then again, we have a similar situation where earning is not doing that great. Lots of acquisition for Tecsys as well. So we have basically the same story, the same narrative that we had with OpenText. We can find it with Tecsys, a company that is growing their revenue like there's no tomorrow, strong cash flow there as well, and very solid dividend growth. However, earnings are not necessarily the best metric to look at what's happening there, so we have to dig a little bit deeper again. How do they fuel that growth? Well, first thing is they're not only able to retain their customers, as I mentioned earlier, very sticky business, but they are also able to make cross-selling offers for their clients. So their retention rate is actually over 100% for that reason. So basically it means that they are losing some clients every single year, that's for sure, but in general, they are able to increase the number of products or the cost of the subscription-based model to their existing customers, so they increase their retention rate this way. And this is a key element, a key factor to track when you are thinking about investing in a SaaS business. You want to make sure that the company is able to retain their client and increase that subscription, because the power of this business model is whenever you start a new year, you have all those subscriptions that are coming in again and again and again, but you want to make sure that there's a retention rate there. Now remember when I showed you that tech bubble graph a few minutes ago and I told you it's not the same story right now? Well, now you can see how fast the company is growing. So this is their backlog. It is growing rapidly, and especially in the SaaS business. So again, they're telling you we're not only going to make money today, but we're going to make money today and then the year after and the year next and following for maybe like 5 in the next 10 years. So this business is just going to continue growing, because you know what? Complex supply chain is not about to disappear. We are living in a world where, especially with e-commerce growing, managing warehouse, suppliers, and demand, and then customers spread across the country, those things are going to be part of our life, part of the new business model for many businesses for the next decade, and if not even more. And Tecsys is developing this incredibly strong expertise in this niche market, and they're there to stay for that reason. In conclusion, when you look at the payout ratio, a lot healthier than with OpenText, but when you look at the cash payout ratio, roughly 50%. So the company has plenty of money to grow by acquisition and also to reward shareholders. I also like the fact that they don't have much debt. We're talking about 10 million in long-term debt. Keep in mind that Tecsys is a lot smaller than OpenText in that regard. In fact, Tecsys market cap is about 900 million, $1 billion, and OTEX is 17 billion, so it's 17 times larger than Tecsys. Still, $10 million in long-term debt with a cash flow from operation for the past 12 months of 8 million. So it's basically able to write down its debt almost an entire year just by the cash flow that they're generating. It's not going to happen, but just to tell you that they have plenty ample of money. Once again, the PE ratio looks ridiculous at 200, but then it is mostly due because of the earnings drop in regards to acquisition. You can't really go with PE ratio in this case. You have to look at how much the company is generating versus their operation, because they're going to keep adding new businesses in their portfolio to make sure that they keep that edge against competitors. And obviously with such a complex niche, they want to make sure that they are always the best in class and they don't get swallowed by other big techs. This is always a risk for smaller companies. Tecsys is one of them. $1 billion market cap today is pretty small, especially in the tech world. You have to be careful with that. But so far, when you look at the dividend triangle and you see that the SaaS revenues are growing, the ARR is growing, and also the dividend is growing, those are the indication that you should follow and say, well, is this company will be able to continue to thrive in the future? Those indicators are all green, and this tells me that it's going to keep up going higher. Expects lots of fluctuation once again, but that's part of the deal when you're dealing with small tech stock. Speaking of which, now we're going to go even smaller. We're going to go in an adventure in the TSX venture. Sylogist would have been a dividend aristocrat if it would be trading on the TSX, but since it's a super small cap, so in comparison, OpenText 17 billion market cap, Tecsys roughly 1 billion market cap, Sylogist less than 300 million, so very small company. It has increased its dividend since 2011, and it offers a great dividend yield, especially for a tech stock. So if you're looking for something interesting here, so you have a dividend grower in a tech industry that is growing, and they offer a very solid yield. Sounds like a pretty good deal, and I'm telling you, it's not too good to be true. Sylogist, another SaaS business, as you can tell, has specialized into another niche market. They are helping government, education, and non-profit business to manage their information. And they also have 10% of their business coming from safety and defense. What is great about this business model is they once again have a very sticky business. Government and schools and nonprofit will not likely jump from one service provider to another. And this is a great way for Sylogist to grow their business and to count year after year on a stronger business model with a lot of ARR, annual recurring revenue. Most of the business is coming from the US, but it's Canadian-based company. They pay their dividend in Canadian dollar as well. I also love the fact that they are well diversified. We're talking about over 1,000 clients. No client counts for more than 2% of their revenue. And when I look at the safety and defense and I see names like General Dynamics and Lockheed Martin, I kind of really like that. Then again, this is super sticky business because when those companies, you know, they have such a high level of credential and security in their business, when they deal with an external company, they do their due diligence, and once it's there, they will stick there forever. One possible downside here is because the company is very small, and because it is trading on the TSX Venture, it doesn't get lots of market love and doesn't get lots of attention. What you see here is the company is making more money year after year. They're growing, but their stock price pretty much stays the same. So if you're concerned that Tecsys is on the bubble and you're just like, yeah, it seems like just crazy to pay such a high valuation, and I know it's growing, but I'm not comfortable with it, Sylogist would be a very good choice here because the company is growing, but their stock price has not moved that much over the past 5 years. The good indication that at one point in time, if the market wakes up and they decide to give more value to Sylogist, the shares are ready to boom. When we look at their dividend triangle, we can clearly see the stock going sideways. We see revenue is trying to increase from 32 million to 38. It has a slowdown in 2020, so it hasn't been a great year for them. And then for the earnings, and we're going to talk about that in a moment, but you can see the huge drop on the last year in 2020. This has plenty of implication, but earnings got destroyed in 2019, and now we're almost getting ready to see earnings increase. I'm going to talk about it in a moment, but what I want to show you here and what I think is the most important part is the dividend growth. The company increased its dividend twice in 2020. So if you take a moment to sink that information and think about it, we are in the middle of a recession. People and businesses are cutting down on costs. The pandemic brings a bunch of uncertainty, and this company increases dividend by 25% across 2 dividend increase. So the first one was not like a mistake, and they're just like, oh my God, I should have not increased my dividend in the first place. No, they did it twice. Double-digit dividend grower here. Very interesting, and we're going to look at that part. But first, let's talk about the earnings for a second. Here's free cash flow from the company. You can see there's a huge problem there. And this is the key when you study companies, when you look at trends. Look at graphs showing you 3, 4, 5 years of information to do your digging. Because at first when you look at it, it's like, yeah, there's something wrong. The company's going down. I'm not buying. Well, then you have to think again. What you see on that graph, huge drop in cash flow. And that has been explained because at the end of 2019, they have changed management compensation. This had a huge impact because they had to write down a check of like over $10 million in cash. It hurts earnings as well, and this is what happened there. They kind of like moved the entire management compensation team to make it more inclined to success for new board members, and I think that was done because they knew they would change a lot of people on their board, and it was to incentivize and attract new talent. Now that the situation is over, I expect to see cash flow and earnings going higher up, and especially because the company seems very optimistic for the future. They did a board refresh, they have a new CEO, they want to move forward, and I can see a little bit like Tecsys, what happened to them a few years ago when they had a new CEO and they did the rebranding and they wanted to focus a little bit more on complex distribution, and the stock kind of like explode. I have a feeling, and maybe I'm wrong, and you have to do your own due diligence on that, obviously. No buy or sell recommendation here, but I have a feeling this is why I bought Sylogist in the first place. And I have the feeling that this company is about to change a little bit their business model maybe, and then show additional growth. They have renewed their partnership with Microsoft, which is very good for them, with similar terms. Therefore, the company has a solid business model. They can continue what they do best. But going forward, I'm expecting a little bit more growth at this point. Now, looking at the payout ratio and cash payout ratio, I've already explained you that before. Earnings drop, free cash flow drop. Well, guess what? Payout ratio 400% and 500%, which is kind of ridiculous when you think about it, right? Then look at the debt. There's no debt whatsoever. So when you're thinking about how could a company increase its dividend by 25% with 2 increases in the same year while showing ridiculously high payout ratio, well, you have to do further digging. And this is what we do at DSR. We actually go deep inside and found those answers when we see something that doesn't seems right when we look at the dividend triangle. Cash flow from operation will start to go back up once the 2019 is off the radar. So probably next quarter, we're going to see it increasing. And the most important part here is if the company is making recurring revenue and they have no debts, it tells you that they're just going to make a lot more cash coming in for the upcoming years. This means more growth by acquisition. This means more dividend growth as well, and cross-selling opportunities. It's pretty much the same theme for the 3 stocks, and I want to finish with this chart showing you adjusted EBITDA, telling you how the company makes more profit year after year, and the red line over there is the EBITDA margin. So it's one thing to generate more profit, but it's even more interesting when you look at it in a way that the company is actually growing their margin. They're improving their margin. So every single dollar that comes in, they make more money out of it. The company has no debt. It has access to a line of credit of 40 million. So they're ready to make more acquisition. And I also love the fact that 50% of ownership comes from management. So management interests are completely aligned with you guys. I love this company. You have to be patient, obviously. Small cap, TSX venture, expect lots of volatility, and sometimes they will have like great news and there will not be that much movement in terms of stock price. You have to be a little bit more patient on this one, but at 4% yield with a high single-digit to double-digit dividend growth potential moving forward, 9 years of dividend growth as well, I think it's more than enough to be patient and to wait, don't you think? All right, so if you have enjoyed this video, if you have gained more conviction to invest in Canadian tech stocks, give me a thumbs up, subscribe to the channel, it helps me a lot. And until next video, stay invested.